Macroeconomic environment is being rendered highly uncertain by divergent monetary policy actions and intentions by central banks across the world. Financial market volatility and geopolitical tensions are adding layers of ambivalence to the overall global outlook. Notwithstanding a highly transmissible third wave driven by the Omicron variant of COVID-19, India is charting a different course of recovery from the rest of the world. India is poised to grow at the fastest pace year on year among the major economies, according to the projections made by the International Monetary Fund, that is the IMF. This recovery is supported by large-scale vaccination and sustained fiscal and monetary support. Once again, frontline warriors have admirably risen to the call of duty. As we gain valuable experience from repeated waves of the pandemic, our response and our overall responses are also becoming nuanced and calibrated. Protecting life is paramount, and protecting livelihood is rising in the hierarchy of priorities. The focus is on securing the economic and financial conditions of the vulnerable, the wage earners, and all those who have been affected the most. Accordingly, the emphasis is shifting to targeted containment strategies and a push towards universal vaccination and booster doses. This approach is being complemented by increased adoption of technology in our workplaces and in our day-to-day lives. The effort is to limit the extent of disruptions to the economic activity. In this overall environment and this background, the Monetary Policy Committee, that is the MPC, met on 8th, 9th and 10th February 2022. And based on an assessment of the current macroeconomic situation and outlook, it voted unanimously to keep the policy repo rate unchanged at 4%. The MPC also decided by a majority of 5-1 to continue with the accommodative stance as long as necessary to revive and sustain growth on a durable basis and continue to mitigate the impact of COVID-19 on the economy, while ensuring that inflation remains within the target going forward. The marginal standing facility, that is MSF rate and bank rate, remain unchanged at 4.25%. The reverse repo rate also remains unchanged at 3.35%. The MPC flagged the potential downside risks to economic activity from the highly contagious Omicron variant. Reassuringly, the symptoms have remained relatively mild, and the pace of infections is moderating as quickly as it surged. There is, however, some loss of momentum in economic activity as reflected in high-frequency indicators such as purchasing managers' indices for both manufacturing and services, finished steel consumption, and sales of tractors, two-wheelers, and passenger vehicles. The demand for contact-intensive services is still muted. Going forward, positive impulses for quickening the pace of recovery emanate from buoyant Rabi prospects, robust export demand, accommodative monetary and liquidity conditions, improving credit offtake, and the continued push on capital expenditure and infrastructure in the Union Budget 22-23. The MPC also noted that consumer price inflation has edged higher since the last meeting, but largely along the anticipated lines. The increase in inflation in December was entirely due to unfavorable base effects despite month-on-month decline in prices. Large buffer stocks of cereals and effective supply-side measures augur well for food inflation. Core inflation remains elevated, but demand pull pressures are still muted. The renewed surge in international crude oil prices, however, needs to be closely monitored. On balance, headline inflation is expected to peak in Q4 21-22, that is in the current quarter, within the tolerance band, and then moderate closer to the target in the second half of 22-23, providing room for monetary policy to remain accommodative. At the same time, output is just barely above its pre-pandemic level, while private consumption is still lagging. Global headwinds are accentuating. Overall, taking into consideration the outlook for inflation and growth, in particular the comfort provided by the improving inflation outlook, the uncertainties related to Omicron and global spillovers, the MPC was of the view that continued policy support is warranted for a durable and broad-based recovery. I think this particular sentence is very important, so let me just read it once again for better clarity. Overall, and growth, in particular the comfort provided by improving inflation outlook, the uncertainties related to Omicron and global spillovers, the MPC was of the view that continued policy support is warranted for a durable and broad-based recovery. I would now like to focus on the domestic growth scenario. In India, real GDP growth at 9.2% for 21-22 takes it modestly above the level of GDP in 2019-20. Private consumption, the mainstay of domestic demand, continues to trail its pre-pandemic level. The persistent increase in international commodity prices, surge in volatility of global financial markets, and global supply bottlenecks can exacerbate risks to this outlook. Going forward, government's thrust on capital expenditure and exports are expected to enhance productive capacity and strengthen aggregate demand. This would also crowd in private investment. The conducive financial conditions engendered by the RBI's policy actions will provide impetus to investment activity. The surveys done by the Reserve Bank reveal that capacity utilization is rising, and the outlook on business and consumer confidence remain in optimistic territory, which should support investment as well as consumption demand. The prospects for agriculture have brightened on good progress of winter crop sowing. Overall, there is some loss of momentum of near-term growth, while global factors are turning adverse. Looking ahead, domestic growth drivers are gradually improving. Considering all these factors, real GDP growth is projected at 7.8%. I repeat, 7.8% for 22-23, with Q1 22-23 at 17.2%, Q2 at 7%, Q3 at 4.3%, and Q4 at 4.5%. I would now like to turn to inflation. The CPI inflation trajectory has moved in close alignment with our projections. In particular, the softening of food prices is providing welcome relief. The improving prospects for food grains production and the expected easing of vegetable prices on fresh winter crop arrivals are adding further optimism. Moreover, the softening of pulses and edible oil prices is likely to continue in response to strong supply-side interventions by the government and increase in domestic production. The hardening of crude oil prices, however, presents a major upside risk to the inflation outlook. Core inflation remains elevated at tolerance testing levels, although the continuing pass-through of tax cuts relating to petrol and diesel last November would help to moderate input cost pressures to some extent. The transmission of input cost pressures to selling prices remains muted in view of the continuing slack in demand. Further, as risks from Omicron wane and supply chain pressures moderate, there could be some softening of core inflation. On balance, the inflation projection for 2021-22 is retained at 5.3%, with Q4, that is the current quarter, at 5.7% on account of unfavorable base effects that ease subsequently. In particular, CPI reading for January 22 is expected to move closer to the upper tolerance band, largely due to adverse base effects. Taking all these factors into consideration and on the assumption of a normal monsoon, CPI inflation for 2022-23 is projected at 4.5%. I repeat, CPI inflation for 2022-23 is projected at 4.5%, with Q1 22-23 at 4.9%, Q2 at 5%, Q3 at 4%, and Q4 at 4.22%, with risks broadly balanced. At the current juncture, the conduct of domestic monetary policy is primarily attuned to the evolving inflation and growth dynamics, even as we remain watchful of spillovers from uncertain global developments and divergent monetary policy responses. Our monetary policy would continue to be guided by its primary mandate of price stability over the medium term, while also ensuring a strong and sustained economic recovery. As stated by me earlier on several occasions, our actions will be calibrated and well telegraphed. I would now like to touch upon certain issues relating to financial stability. A strong and well-functioning financial sector fortifies the foundations of growth and development. The Reserve Bank has accorded the highest priority to preserving financial stability by taking quick and decisive steps to ease liquidity constraints, restore market confidence, and prevent contagion to other segments of the financial market. We have been also strengthening the regulatory and supervisory framework for both banking and non-bank financial sectors to proactively identify, assess, and deal with the vulnerabilities. Thus, despite the pandemic-induced bouts of extreme volatility, the Indian financial system has remained resilient and is now in a better position to meet the credit demands as recovery takes hold and investment activity picks up. The balance sheets of scheduled commercial banks are relatively stronger, with higher capital adequacy, reduced NPA, higher provisioning cover, and improved profitability. Watchful of the impact of the pandemic on the banking and the NBFC sectors when the effects of regulatory reliefs and resolution fully work their way through. Banks and other financial entities would be well advised to further strengthen their corporate governance and risk management strategies to build resilience in an increasingly dynamic and uncertain economic environment. They also need to continue the process of capital augmentation and build up appropriate buffers. I would now like to touch on certain issues connected with liquidity and financial market conditions. The pandemic has delivered a once-in-a-century crisis with a health shock morphing into a macroeconomic and financial shock. The RBI undertook a slew of measures to deal with such an exceptional situation. As a consequence, borrowing costs fell to their lowest levels in decades and spreads narrowed across rating cohorts. Record levels of government securities, corporate bonds and debentures were issued. Corporate entities and reduced high-cost debt while improving profitability and retained earnings for future capital expenditure. Overall, the financial sector has remained fully functional and has anchored the process of economic recovery. In our assessment, the policy actions of the Reserve Bank have yielded the desired results in a smooth and orderly manner. With these objectives being achieved on an ongoing basis, the Reserve Bank has turned to rebalancing liquidity on a dynamic basis, while maintaining adequate liquidity in support of its accommodative stance. This rebalancing has involved two-sided operations. First, that is on the one side, rebalancing liquidity from overnight fixed rate reverse repo towards 14-day variable rate reverse repo, that is VRRR auction, as the main operation, supported by fine-tuning auctions of varying tenors as envisaged in the revised liquidity management framework of February 2020. And second, that is on the other side, conducting repo auctions of 1 to 3 day maturity to meet transient liquidity mismatches and shortages, as for instance in the recent case of more than expected GST outflows during the third week of January 2022. The key to effective liquidity management is the timing and having a nuanced and nimble-footed approach that responds swiftly to the manner in which liquidity tilts. As a result of RBI's rebalancing operations, the daily average absorption under fixed rate reverse repo has moderated sharply since August 2021, when the rebalancing started. Overall, system liquidity, however, remains in large surplus, though it has moderated over the same period. Reflecting the migration of surplus liquidity from overnight window to longer tenors, the effective reverse repo rate, which is basically the weighted average rate of fixed rate reverse repo and the VRRRs of longer maturity, the effective reverse repo rate increased from 3.37% as at the end of August 2021 to 3.87% as on February 4, 2022, that is last Friday. It may be recalled that while instituting the revised liquidity management framework on 6th of February 2020, the daily fixed rate repo and the daily fixed rate repo and the 4 14-day term repos within a reporting fortnight were withdrawn. In view of the pandemic and the related work from home social distancing protocols, the MSF and the fixed rate reverse repo windows were made operational throughout the day, instead of only at end of the day under normal circumstances. This passive mode of liquidity management worked well throughout pandemic conditions in ensuring adequate provision or absorption of liquidity as warranted by the evolving market conditions. With the progressive return of normalcy, including transient demand for liquidity from the Reserve Bank, it is logical to restore the revised liquidity management framework in order to make it more flexible and agile. Accordingly, 4 decisions have been taken. First, variable rate repo operations. I repeat, variable rate repo operations of varying tenors will henceforth be conducted as and when warranted by the evolving liquidity and financial conditions within the CRR maintenance cycle. Second, variable rate repos, that is VRRR as I would call it, variable rate repos and variable rate reverse repo, that is VRRR of 14-day tenors. So variable rate repo operations and variable rate VRRR auctions of 14 days tenor will operate as the main liquidity management tool based on liquidity conditions and will be conducted to coincide with the CRR maintenance cycle. Third, these main operations will be supported by fine-tuning operations to tide over any unanticipated liquidity changes during the reserve maintenance period, that is during the fortnight ending on the reporting Friday. Auctions of longer maturities will also be conducted as warranted. Fourth, with effect from 1st of March 2022, the fixed rate reverse repo and the MSF operations will be available only during 17:30 hours to 23:59 hours, that is from 5:30 p.m. to 11:59 p.m. on all days and not during 900 hours to 23:59 hours.